So good evening, friends, and a very warm welcome to our quarterly webinar on the markets. So we are at a time when we are at a very high level of global uncertainty, and sharp market volatility which is going on. I mean, it started with the escalation of the U.S. Trade tariff, which is going on, where U.S. has been raising tariffs on imports across the globe, and with China retaliating. And I believe this will cause a lot of inflationary concerns. On the domestic front, also, we have seen a brief correction, but then we have again seen the Nifty rebounded, and the sentiment is gradually turning positive. But however, the recent incident, we are now unsure of the geopolitical situation even in our subcontinent. In fact, today the markets corrected by nearly 1%. As regards the equity markets, there has been extreme volatility in the past 6 months. But despite a decline of nearly in the last 6 months from October 24 to March 25, with Nifty falling by nearly 9%, mid cap by 14%, and small cap nearly 18%. From April 1 till date, till yesterday, in fact, not today's, Nifty was up by 5%, mid cap nearly 7%, and small cap was up by around 6%. On the international front also, while a few concluded with losses in 24-25, we had Hang Seng gaining nearly 40%, and Nikkei was the biggest loser. The S&P 500 and Nasdaq was up nearly around 7% and 6%. The interest differential between India and US has narrowed from a gap of 3.4% to now only around 1.5%. So the retail inflation is also reduced from 4.83 to 3.34. I think mainly due to the crude effect. The FI flows have been completely negative in the entire 24-25, with nearly 1.27 lakh crores being as an outflow, and in 23-24 it was actually an inflow. But DIs have matched this equity inflows with nearly 6 lakh crore of investment in 24-25. In fact, even the first 16-17 days of April is net negative as of now, even though they have turned positive in the last couple of days. Today, in fact, we are delighted to have with us Manish Gunwani, the head of equities at Bandhan Mutual Fund. And Manish brings with him over nearly 25 years of experience of equity research and fund management. And he is known for his exceptional track record of wealth creation for investors. Before joining Bandhan in January 23, Manish served as the CIO at Nippon Mutual Fund. And prior to that, he was a deputy CIO at ICICI Prudential. He is an alumnus of IIT Madras and IIM Bangalore. So he has a very good pedigree as a professional. And he combines a deep analytical insight with strong strategic vision. In fact, post joining Bandhan, the schemes which are managed by him have seen jumping from nearly 12,000 crore to nearly 30,000 crore. And Bandhan Small Cap has been in the absolutely top performer, I think, in the last 2 years. So we are actually, truly thankful to have with us today and to share his perspectives on, how to navigate in the current market volatility and what is his outlook on the market and how the tariff war will pan out. So I now invite, Manish to share his thoughts. And as always, we will take a Q&A session after his speech. Over to you, Manish.
Sure. Thanks, everyone. Thanks for your time. Maybe I'll just summarize my thoughts in about 10 to 15 minutes, and then we can have a discussion around the market outlook. See, first of all, when we see 2 or 3 big long-term trends, I think there are broadly 3 things that we are very convinced about. One is that when you see the Indian household balance sheet, equities is still the least asset by saving. So when you have 4 big asset classes, which is gold, real estate, bank FDs, and equities. Equities roughly 100 lakh crore, real estate is about 500 lakh crore, gold is 250 lakh crores, and bank FD is 150 lakh crores. So we think that, first of all, that the domestic flows structurally will be strong, because clearly real estate is low return, difficult to manage. Gold has already done well. Bank FDs post tax, the return is not great. So that is the first long term trend. The second long term trend, and I think it's important for investors to remember this, that long term return on equities is more a function of inflation than anything else. See, when we talk of equities, people tend to talk a lot about GDP growth, about near term events, etc. But if you are looking at long term, when you want to do asset allocation, it is important to remember that across multiple countries, the long term return on equities is roughly inflation plus 5 to 7%. So whether it is US, whether it is Japan, whether it is India, when you see data on 10, 20-year basis, you take the consumer inflation of the country, add 5 to 7%, and that typically tends to be always the return on equities. So in fact, even if you see today on a 10-year basis, Nifty 500 is exactly, the return is exactly inflation plus about 6.5%, which is more or less in line with long-term average. Long-term average maybe about 5.5, 6%. So what we call real return, that is the return above inflation, always converges to 5 to 7%. That is true of everywhere in the world. So that is a good way to see what to expect from equities. See, there are times it becomes the 10-year return is very low, and obviously it's a better time to buy equities. So 6.5% is fair value. We don't need to be very defensive. We don't need to be very aggressive. That is what the data is suggesting. And third, in terms of how the Indian economy looks like, we think that India is somewhere like US in 70s, where from now more knowledge-based industries, which have technology, which have brand, which are platform businesses, they will start becoming bigger and bigger, both as part of economy and as part of the market. Because you see what happens, there is a phase in the economy where a lot of physical things get built, roads, telecom, your real estate, etc. But once that basic infrastructure is in place, and even those industries grow, but if you see what happened in US post World War II, for first 30 years, a lot of activity on roads, telecom, etc. But after that, the technology sector, the branded apparel, the retailing sector took off. And we think India is broadly at that stage where we will see a lot of brands and technology take off. So that is the long-term view. More from a 3 to 5 year perspective, generally we expect global GDP growth to be softer than last 20, 30 years. See, demographics is becoming an issue that most of the rich countries, US, UK, Europe, China, Japan, and India, um, there the birth rates are falling faster than people thought. And most of these countries today have a peak population and slowly it's degrowing. India at a country level is okay, but most of the richer states, Maharashtra, Karnataka, the south and west states, there the birth rate is as low as Europe. So a lot of these states will see population degrowing in 5, 7 years. So overall, at a global level, demographics, the fact that the working population as a percentage of total population is coming down. So that is a big issue. Also, the protectionism, what we are seeing as tariff wars. But in general, even before Trump came, uh, the world was seeing a slow um, kind of growth. The trade was slowing down as a percentage of GDP, and now obviously it has accelerated. So if you go back, 1980 to 2010 was the golden period of what we call globalization, because free trade went up exponentially. So as a percentage of GDP, the goods exported or imported, they went up a lot, because every country thought they will do what they are good at. So China obviously became big in manufacturing, India became big in services, and a lot of other small emerging markets. They did various kinds of things which their country was good at. Now what is happening is that uh, countries are saying, no, we don't want to outsource. We want to keep jobs inside our country. Now, typically, this is what India was before 1991. The protectionism was there. And that is not good for growth, because obviously no country is suited to do everything. But because of geopolitical, because of security, because of wanting to keep jobs within the country, uh, these things are being manufactured now within the country rather than being outsourced. As I said, that is not good for growth. So that is the second reason why we think generally growth will be slow. Uh, but why I think Indian stock market will do well and Indian assets in general will do well is basically because India's macroeconomic numbers are too good. So if you see, for many decades, India had a current account deficit. Basically, our imports were more than our exports. Now, what is happening is that because our services exports have done well and oil is prices are weak and are likely to remain weak, our current account is today virtually zero. So if you remove gold from our import bill, and we can say that gold is not consumable, it is an asset, then we can say that today we are literally 0% current account deficit, because our total exports of goods and services versus our total imports of goods and services are roughly in balance. Now, why this is important is ultimately a currency will depend on current account. That is the biggest variable which affects a currency. And last 20, 30 years, current rupee was depreciating 3-4% because our current account was 2 to 3% of GDP. That is, our imports were bigger than our exports. Now, with imports and export being equal, rupee will depreciate less. Earlier, it used to depreciate 4-5%. We think next 5-10 years, it will depreciate at 1 to 2%. And therefore, a lot of foreign capital will come in, not only in equities, but FDI or in Indian debt or whatever. Because if rupee is not going to depreciate more than, let's say, 1-2%, then let's say an Indian 10-year bond at 7% becomes 5 to 6% in dollar terms, which is a very attractive option. So we think slowly, as this strength in currency plays out, you will see reasonable amount of foreign capital coming to India. See, doesn't mean every 6 months or 1 year. Obviously, last 1 year, foreign capital in equities has actually gone out. But we are talking across 3-5 years. And if you see in fixed income, in FDI, over last 5-7 years, some decent foreign capital has come in. But I think from here on, that trend will accelerate. And the third thing from a 3-5 year perspective is we are positive on what part of Indian economy will do well, because ultimately we have to play sectors and styles and themes. We think that where there is educated input required for exports, where graduates or postgraduates are working, what we call the white collar workforce is working, because those goods and services are slightly difficult to make in by automation or by cheap labor. And we can't compete with Bangladesh or Africa in cheap labor. So we think that, let's say, engineering, pharma, auto ancillary, specialty chem, defense, these sectors where India has an educated workforce which can contribute to producing these goods and services, or even software products and services, these are where India will do well in the next 3, 5, 10 years. And those are the sectors we are bullish on. Now, just coming last bit on what we think of the more recent things. I think on top of everyone's mind, tariffs, and obviously there has been a lot of back and forth from Mr. Trump on this. Um, but what we are kind of understanding from a very broad level is this, that uh, if the dollar does not appreciate and if US economy slows down, we think that a lot of these tariffs will get diluted. Why I'm saying that is that, see, first of all, dollar falling is as good as tariff, because for someone who's selling to US, if the dollar is falling, then it's not as remunerative as it was before. So in a way, imports to US get discouraged if the dollar falls, and it becomes more attractive to produce in US itself. So I think their logic for putting tariffs was to finally get um, some manufacturing in US and to reduce the trade deficit, because their exports were much lesser than their imports. A dollar depreciation achieves that. So we do think that the extreme tariffs that were talked about in March, given that the dollar has fallen, first of all, there is a very good chance that they will get diluted and the tariff rates will come down. Second is, we think US is specifically targeting more action against China, and the tariff now is around other regions like Europe, India, etc. It's just a negotiating tactic in one way. Uh, so clearly, when you see the narrative around China for for US is very different from other regions, and I think they see China more as a military problem, not as an economic problem. So while they want to reduce trade deficit with every other region, they also feel that trade surplus of China is letting China build a military capability which is going to threaten US. So ultimately, some of these things which US is doing is actually good for India, in the sense that they want dollar to come down, which is good because when dollar depreciates, capital starts coming into developing countries. They want oil prices to come down, which is good for India as well. And they want to reduce the trade deficit with China. Now, one is, of course, stop Chinese exports to US, but someone will have to provide some of the things which US can't produce. So a lot of the medium to low end products, we don't think that US is competitive enough to produce because there the labor cost is very high. So we do think that while short term is very tricky, medium to long term, this is very good for India, because let's say after all the dust settles, if the tariff differential between China and US, India is about 30-40%, then a lot of the manufacturing segments from which China was exporting to US, clearly India will become very competitive. So I don't think everything is negative about tariffs. I think the logic behind tariffs is something which is not bad for India. As I said, dollar weakening, oil falling, and China reducing manufacturing are things which are good for US, good for India, sorry. So that is on the tariff side. In general, we are seeing US economic data softening. We do think that a slowdown in US is broadly given. Uh, Whether it is a mild slowdown or deep recession is where it is very tricky to call. But the fact that even if these reciprocal tariffs are not there, but effectively about 15 to 20% import duties have been implemented, which will push up inflation. It will hurt US business. It will hurt US consumer, and it will keep interest rates higher. Um, this will all drag down US economy for sure. That's the general belief. So the risk will be not that US will slow down, but if US goes into a deep recession, then it is the biggest economy, and that will drag the entire world into a recession. So we have to be mindful that this is going to be a very volatile year, given the valuations, given the risk of US slowing down. We have to be reasonably cautious from a 6 month perspective or a 1 year perspective. However, our long term call is actually that small cap is the best space to be, because, as I said at the beginning of this talk, that the long term view is broad GDP growth will be soft, but liquidity, especially in India, will be strong. And therefore, the smaller companies which grow faster, some of obviously not all of them, but the thing with small cap is because the variety is very high. There are some stocks which are very cheap. There are some stocks which we can find which can grow faster, and I think that is where the big money will be made, because if broad GDP growth is low, if our India's nominal GDP now probably will be 10-11% rather than 14-15%, then very large companies which can't get market share because they're already large, I think those will struggle. And therefore, we think that investors who have 3 to 5 year perspective um, should brave this volatility and go for small cap fund or some thematics like financial services and innovation, which are fast growing verticals. So that is our view. So if investors are a bit risk averse, they have a 1 to 2 year horizon, then flexi cap or core or value fund may be more suitable. But for investors who can, weather the storm for 3 to 5 years, I think they will be rewarded with much higher returns in the small cap fund. So with that, I'll pause and we can open the floor for questions.
Thanks, Manish. I think you summarized it quite well. Giving a long-term, medium-term, and a short-term trend. And I think so. Coincidentally, we had a quite an interesting question in the poll, right? And so I would actually, like to take that. So since you mentioned about the more about the USD, right? That you expect it to be weak. So we just had one question, right? So we just wanted to take a poll which I've launched it. That where do you see USD INR by March 2026? Whether do you see it above 90, below 82, or do we see it in the range of 82 to 90? So let's see what the audience says, and then I will take your view on what do you think.
Sure, sure.
Mhm. Just wait for maybe another 30 seconds. Okay, we'll just end the poll. I'm just sharing the results. So you see, 63% feel it is between 82 to 90. That 22% feel that it will be above 90. I think so. Yeah. That's very aggressive.
Yeah.
And below 15% is below 82. So what's your take, Manish? Where do you see?
I'm with the majority, 82 to 90. See,
Okay.
I think rupee is strong, but we also have to be competitive against yuan and other currencies.
Hmm.
So RBI will not let it appreciate, I think. So I think we will be somewhere around this, in fact, maybe 84 to 87 kind of range.
Okay.
But the thing is, I think if I take a 3 year, 5 year perspective, I think we will be very stable over next 3 5 years, which will what will attract investors.
Okay. So I think we expect rupee to be fairly stable and with a 1 to 2% appreciation. So, because so Manish, there is a lot of talk in terms of we keep on talking and hearing about that de-dollarization. Like
Yeah.
means everybody talks that that dollar will lose its reserve currency. In fact, Trump even made a statement that if BRICS comes out with his own currency, we will impose more tariffs. I don't know where he came up with that for,
Yeah.
but so how do you how do you see this panning out maybe over a longer term trend itself also?
No, I think definitely people will move away from the dollar, but it will remain the dominant currency. I wouldn't call it the reserve currency. See, the simple point of this thing is that there is no other liquid currency of the scale of USD which can be used for trade. Gold is one option, but gold cannot be used for trade. You can use it to park money, but you can't use it for trade. So what will happen is, I think the world's reserves will basically get distributed more than, see, today roughly 56 to 60% of reserves of every country are in US dollars. What I feel is that maybe in next 10 years, this will become 40 to 50 rather than 50, almost 60% now. But 40 to 50 means it will still be fairly dominant because yuan is not very liquid, it's not fully convertible. People don't trust Chinese geopolitics. Europe is that political union sometimes seems fragile, and it's also not very high growth economy, and it's not very dynamic economy. So we don't have too many options to replace dollar. But at the same time, as I said, fundamentals of the dollar are weak in terms of current account being high, inflation being relatively high. The government debt to GDP in US is scary. It is 120, 130% of GDP. And I think the problem for US is they are trying to get the current account in control, but at the same time, they need to be attractive as an investment destination because their government deficit has to be funded. So it's very difficult balancing act for them. Um, so yeah, net I do think that US dollar will decline, but very very slowly.
Okay. And when we yuan itself is again it's a managed currency, right?
Yeah.
So if US tries to depreciate its currency, there's also a possibility that yuan may again devalue his currency, and will that have an impact on India in terms of against the USD then?
No, definitely. I think the biggest risk to the one of the biggest risks to the markets is if yuan is sharply devalued by 5 to 10%. Because if these current tariffs continue on China, China may be tempted to use yuan devaluation. But having said that, I think the hurdles are quite a few for yuan devaluation in the sense that, first of all, China wants to appear like a stable economy. So this time, unlike the first term of Trump, when yuan devalued by almost 18%, I think they will not want to appear weak by having a currency which is sliding. Second is that Trump himself finally wants dollar to be competitive for trade. So I don't think, in fact, I think he also want China not to devalue yuan. So I don't think it is both US and China's interest to have this sliding yuan, which keeps the trade deficit with US high. And thirdly, I think, see, China is now trying to build a case against US by siding with some of the emerging market countries. So if yuan devalues and the emerging market countries also face pressure, I don't think then this strategy will work. So I think while it is a risk, but I think this time it looks unlikely.
Okay. Okay, thanks. And one more thing, I mean, you made a statement that, for long term, you should actually be looking at small cap, and generally, investors see a lot of volatility in small cap. So, I mean, that's a quite a bold statement. And we have seen that, last 3 years, we have seen that it is the mid cap and small caps which have actually been outperforming, and, the large cap has been a laggard. And and if we, in fact, actually, if we see even the flows in the current year, most of the flows is into the large cap funds, right?
Yeah.
So I mean, don't you see like a mean reversion happening, that this year large cap would perform better than small cap, or you still stand by on the small cap side,
No, see, clearly in a challenging macro environment, small caps can be volatile and large caps this year are likely to outperform. But see, timing all these macro events is very difficult. My simple point is this, that real GDP growth and nominal GDP growth globally is coming down. If you see, India also earlier our nominal GDP used to be 13-14%. Now it is 10-11%. In fact, there may be years where India's nominal GDP falls below 10%. Correct. Now, in an environment where the nominal GDP growth is less, but the liquidity is high because both domestic and foreign investors like India as a country, like the growth, like the currency, then I think growth will typically happen where there is a technology change, where there is a trend like China plus one in manufacturing, where there is a demand supply gap like power or defense or something like that, right? So we will get these short cycles where there will be opportunities. And my view is unless we play these cycles, the large companies will basically return broadly in line with nominal GDP growth. So their return is falling. So if
Okay,
you see Nifty 100 over last 2-3 years has not done anything much, right?
correct.
Because see, I'll give you an example of banking, right? If you go back to decade of 2000 to 2010, roughly our banking credit growth was about 15 to 20% CAGR for 10 years or something. But slowly today, if you see last 7-8 years or last 2-3 years also, it is more 10-11%. Correct? So I'm just saying that if banking credit growth comes down, then a big sector like banks cannot return as a stock price what it was returning in 2000 to 2010. Because that sector has matured. It has become very big and the country's growth itself is lower. So then obviously that sector will follow country's growth. And if you buy a very big bank, which is already big in market share, then they cannot outgrow the industry because they're already big. So my point is that a lot of the big industries will just follow nominal GDP growth, which is less today than used to be. And they cannot get market share. So their earning growth will roughly again be in line with nominal GDP growth.
Okay.
And but at the same time, there are new technologies emerging, there are new management teams which are emerging, there are new trends like China plus one and power demand growth globally. So basically the beta of Indian market is come down. So to create alpha, you have to go down the market
Okay.
cap curve, I think.
Okay. Good point. Amarnath, to you.
Yeah, just a second. Yeah. Hi, Manish.
Hi.
Okay, I think you have addressed almost everything that I had also penciled in, but just to sort of put some, quantitative numbers to pin you down a bit more. You mentioned about, preference more towards the small cap for a 3 year perspective, and maybe for a less than 3 year, maybe it could be more balanced. So just
Yeah.
for our audience, if you could peg it down to what percentage for a 3 year or longer perspective would you say should be the allocation towards small cap funds and small cap kind of things? I mean, would you go to the extent of stretching it to say 40% plus, which is unconventional so far?
That obviously will depend on risk profile, depending on age and target and whatever. But yeah, I mean, I will say that if I have 100 rupees in equities, I wouldn't be less than 30 to 40% in small cap. But mind you, when I say that, you should probably look at that even if you own a flexi cap fund, 10 to 15% of that might be small cap. So maybe I'm not saying that own 40% in small cap fund itself, but if I have, let's say, 5 funds in that 100 rupees, mentally, I would roughly want to own 30 to 40% at least in small caps.
From an allocation perspective.
Yeah.
Thanks. If we can just add one more question, I think last 2-3 years we have become believers in the view that our savings is household savings are getting reallocated towards equities from deposits and fixed income kind of pursuits. You mentioned about gold, uh, in terms of the value of the asset being about 3 times of equities.
Yeah.
So do you think gold would also start switching towards equities, or is that a much more longer term play?
This is a very sensitive question because nowadays a lot of people outside markets are laughing at people in markets saying that we have held gold for 20 years and you guys do so much hard work, but you not produced returns as good as gold. So a lot of housewives are looking more smarter than fund managers right now. So yeah, see, roughly gold today is about 250 lakh crores in terms of what households are owning, and equity is about 90 lakh crores. So obviously gold has become very big. In fact, last 1 year, I think mark to market gain in gold is about 40 to 50 lakh crores. So it has been a phenomenal addition to a household balance sheet strength. Although, see, obviously Indians don't think of gold as a very liquid thing that they need to sell. But end of the day, it is an asset. It adds to your net worth. Uh, See, unfortunately or fortunately, maybe we all know in assets, flows chase performance. So I don't think people will switch gold to equities, and somehow Indians, I don't think have that mentality of replacing gold with any financial asset. Um, they either hold gold or in need they will convert it to consumption, but I don't think anyone objectively says I will move 5% from gold to equities unless it's a new gen. I mean, maybe younger people below 30 years will probably think like someone holding a gold ETF, maybe he will think of it purely as a financial investment. But most of our gold, I think, is with families who obviously view it as a contingent asset, um, as something which protects them from inflation and all that. So no, I don't think we will see gold switching to equities. Um, that's at least that's what I see around me.
Oh, thanks. Thanks. Back to you, Juzer.
Manish, there's one question from the audience which I'm just taking. That how would gold dollar behave with specific regard to the world turmoil?
No, gold obviously benefits if there's too much uncertainty, which has played out. So, frankly speaking, I will not personally buy gold at this price. It just seems too overheated to me. But having said that, one can't deny the fundamentals behind gold today are looking very strong in the sense there is uncertainty in policy. There is de-dollarization. I think a lot of central banks are buying gold because they have too much of dollar assets. So yeah, there are reasons for gold going up. And if uncertainty continues, I would say gold will do well. Dollar is a bit difficult because see, apart from tariffs, I think generally the narrative around US is obviously weakening in the sense that uh, the fact that the president wants to fire the central banker, the fact that the administration is fighting prestigious universities like Harvard, etc., the fact that they committed to stopping the Ukraine war, but they have not succeeded. The fact that China has stood up very strongly, they're refusing to negotiate on tariffs. So the soft narrative, not the numbers, but just the way US is behaving, I think it is unnerving a lot of people who hold the dollar. And generally, medium to long term, I fundamentally believe dollar is overvalued. Um, but what happens is if there is a risk of, like if US goes into a deep recession, some credit event happens, then the first instinct is to go back to the dollar. So we may see some sharp up move in dollar if it becomes too risky. But medium to long term, I would say dollar is still overvalued.
Okay. There's one more question. What is your sector choice between IT and manufacturing for the next 5 years?
Manufacturing for sure.
Manufacturing. Okay, so I hope that answers the question. Uh, can we invest lump sum in small cap funds now?
Yeah, I mean, I don't think we should be very defensive. As I said, long term, the benchmark of inflation plus 6%, we are not overvalued, we are not undervalued. So if your allocation is, let's say, 30% in small caps, then if you have money, then you should invest that money.
Okay. But lump sum or should we
No, I
stagger?
think lump sum is fine.
It's fine. Okay. So I hope that answers the question for many people because people always get a bit worried that, with a volatile environment and there were also concerns with regard to the valuation of small caps, but I hope this answers. Now there's a question. I know the answer, but yet I'll ask you the question. So, can we expect a similar return in small cap fund like we have got in the last 5 years?
No. So roughly, I think from here, because it is a market at fair value, I feel the large and mid cap indices will deliver nominal GDP like 10-11%. The small cap index may do a bit better, let's say 13-14%. I'm taking a 5-year view. And a good small cap fund, I think where the difference is, alpha is, I think, relatively more possible in a small cap fund. A good small cap fund can do, I think, 15% plus. But last 5 years, I think most small cap funds have done 20-23%. I don't think anyone should come into a small cap fund with that high an expectation.
Okay. Amarnath, any question you want to ask?
Yeah. My other thing is there is one view emerging, Manish, is that last year we had this 6 lakh crores coming into the mutual funds. Okay, whatever the FIIs did, they did, etc. But the one view is that actually the whole thing got diluted despite this flood of money coming into mutual funds. The indices returns were all single digit, 5%, 7% kind of thing. Mainly was due to the fact that we had this huge sucking sound coming from IPOs plus
Yeah.
QIP plus block trades, etc. So and some people believe that no IPO failed, no QIP got withdrawn, nothing of that happened. So how do you see that playing out? If once things stabilize in the next 12 months or so. Again, are we likely to see that? Because if that doesn't happen, then you could possibly see the secondary market actually delivering much better, I guess, if that pullout doesn't happen.
No, so more near term, definitely, I think, and obviously we talk to a lot of investment bankers. There are a lot of IPOs in pipeline, but I think investors, obviously, the mood is unless it is at very deep value, because let's face it, a lot of the IPOs have not made money, whatever was issued last year. And people are obviously cagey now on new issues. Also, a lot of the mid and small cap stocks which you've been owning for years, maybe they are down 30-40. So there's no need to look at a new stock. I mean, there's obviously a bit of inertia key. If my stock is down 30-40%, why to go and buy a new stock? So I think the hurdle for new, in fact, if you see LG has cancelled its IPO because of valuation reasons. So clearly, investors, I think, have a very high bar in terms of return expectation before they commit to a IPO versus last year. So yes, I think unless the market does well and maybe one or two of the initial ones make big money, then only I think the IPO flurry will continue. Otherwise, it looks doubtful.
Thanks.
I'll just take one last poll since you had a question with regard to which segment to invest. So I think so which segment will outperform this year? So I'm I think yeah, it is got. So whether you feel it's a poll question, large cap, mid cap, or small cap. So let's see where after listening to your thought processes, where do people want to put their
I
money?
think 1 year is a bit short time frame.
Yeah, I understand. Yeah. But like we have seen, like when you do like a heat map, for a year in the last 5 years, we have seen that out of that, most of the time, mid and small cap have actually outperformed, many other categories. So, whether is it the time for large cap to come back, or will it again be the year for the small and mid cap? So we'll just wait for another 30 seconds. So we'll just end the poll. And yep. So I'll just share the results. So this looks more like a multi-cap environment. We are having nearly 36% feel large cap, 39% still feel mid cap, and 25% feel small cap. So
everyone is.
So looks a little different in any case. So anyway, we conclude at 6 o'clock. So it's like good we have been on time, and I think we had a very interesting session as always, Manish. So I'll just summarize, for a thought process for some people who generally miss it out in the beginning front. So your long-term trend basically talks that the domestic flows will be structurally strong. Return should be a function of inflation. In fact, that's a very interesting point which I heard, and it was very, very thought-provoking, because I think if inflation will go down, then the return expectation will also have to go down. Otherwise, people keep on looking at 15% as a return. So have a expectation of around 5 to 6% over inflation with a 10 to 15-year trend. So India is somewhere of the US in the 70s. We expect the global GDP to be, the growth to be softer. Demographic is an issue. I think that is something which is a concern with the population degrowing, and it's very surprising that even in India, the certain states, like specifically Maharashtra, Karnataka, are also actually degrowing in terms of the population. And if the working population comes down, then it's a problem. Protectionism is actually coming back. We expect Indian assets to do well. The macros are very good with the current account deficit, nearly being zero if you remove gold as an asset. So that's I think is a very good sign. And so rupee will depreciate less. I think that should be good for many import-oriented companies also. Not very good for exporters. So I think, but that should actually bring in foreign capital, with there being more stability in the USD. Indian bonds can also become attractive. Engineering, pharma, defense, specialty chemicals, and software is your pick of choice. Plus manufacturing, and you said even financial services and innovation. On the tariff front, it's more a problem of US against China, and more from a military standpoint of view. If the economy becomes stronger, then they become military more stronger. So I think that's a fair point to look at. US economic data is softening, and there could be a mild or a deep recession. That's anyone's guess. Interest rates can remain elevated, so we have to expect a volatile year. And I believe the statement of the entire conversation is that look at small caps. And I think in one way it's also good, because 65% normally you put in small caps, and you have 35% leeway to be into whether it's large or mid cap also. So look at it, and to all the people who are on the call, Bandhan has done extremely well. So you should definitely look at Bandhan as a small cap fund, and we expect a nominal GDP between around 10 to 11 and not 14 to 15. So that's about it. Have a 30 to 40% allocation in small cap with a 5-year view, and in fact you can even invest lump sum. So thanks, Manish. Thanks a lot for joining in with us.
Thanks. Very good summary, I must say.
Thank you. Thanks.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.